From time to time, we see all over social media, all over YouTube, traders talking about structure this, structure that, strategy this, strategy that. And we often rarely talk about the setups that didn't work out or the market conditions that changed out of nowhere. And sometimes that's really what causes us to lose certain trades that we didn't plan on losing. Or sometimes, shoot, that's the enemy that caused a profitable week to go sour. So today we're going to really be paying attention to a market condition that's been occurring quite a lot these past couple of weeks. And it involves some wicks, it involves market losing volume. And so let's talk about it. In this video, though, I want to make sure that by the end of it, you will notice how to take advantage of a setup like this and how to watch out in case this setup actually has been getting in the way of your profitability. Let's get into it. So, the market condition that I'm talking about is how recently during the New York session, US30 would constantly push to the upside, but very quickly will lose volume in the beginning of the New York session. But how it does that is exactly what we want to talk about and how we can take advantage of it. Now, the first thing you want to pay attention to is the previous day's high or low. The reason being is the market loves to go after the liquidity ranges from the previous session or previous day's highs and low. So now at 9:30, when Wall Street volume opens up, it typically sends price action with all the volume, with all the orders back towards these areas. What tends to happen with us traders is we'll see momentum, we'll get into the trade. Next thing you know, it loses momentum very quickly after gathering the liquidity. And then that causes us to be in a trade that turns into a loss very quickly. Now, what you can do to watch out for a setup like this is, first of all, once price is making it close to the previous day's high ranges, that's going to be on your 1 hour time frame or your 30-minute time frame. You will notice the highest point of the previous day's highs. If you are in some trades slightly after market open, you definitely want to plan on taking profit soon as price does make it there. Now, if you want to take a counter trade, for example, what you'll do is you will put the trade, you will place the trade assuming the market does not go too far above the previous day high. You will place your stop loss about a good 100 points above that high to take the counter trade, because once you start identifying that the candle is losing volume and turning into a wick and shifting back to the downside, it is quite normal to take a trade like that and put the stop loss above the previous day high, as price now usually pulls back within range, going back to the previous day's low or the previous session low. So as you can tell here on Monday, February 16th, we noticed that by 9:30, this is exactly what happened. We noticed that price takes off, loses volume, but makes it back down to the previous day low, where there was consequently another wick. Same thing happened the day before as well. That was a Friday. We noticed that soon as the market opened up at 9:30, they sold to gather liquidity, and then they went the opposite way. Now, the key things that I want you to remember is this. Number one, be mindful of the session hours when this behavior is occurring. As we notice, it's happening in the beginning of the New York session. So the best thing you want to do is give the market time to show you the direction that it's heading and the way that the candle will start to either lose volume as it makes it to the previous day's high. Then you will make a conscious decision out of the probabilities of your trading appetite to take either the counter trade back down to the point of interest. That might take about an hour or so, but just keep in mind that at least you have two things. One, you have the range of the previous day's high where you can put your stop loss. And two, you have a pretty good probabilistic idea of where price is going to be heading down. So you take advantage of the amount of points on average that this usually takes as it makes it back to the point of interest. Now, this is why it's important to always pay attention to behavior, because as you are seeing it with me on the charts, the behavior stays constant. If price is going to hit a previous day's high, once they do that, they turn into a wick and they lose volume. They go right back down. They go right back down to the previous session low or the previous day low. So targeting these areas are the best bet for you to take a probabilistic trade like this to ensure that you do end up being profitable out of it. These are the areas that you definitely want to pay attention to during these scenario. All right. So it's three ways you could take advantage of this setup. You either take the buy towards the previous day's high and you exit, or you take the counter trade, sell once price makes it to the previous day high, and you put your stop loss above the previous day high. About a good 90 to 100 points is comfortable for me. It gives a good distance, and then you take it back into the range, aka the point of interest, where the market might have started pushing in the beginning of the session anyway. Now, the third way you could take advantage of this is you wait for price to come back to the point of interest that exists between market open or the previous session lows. All right, so that's going to be your Asian session low, your London session low, and the market open low that it created, because later on into the session, if price comes back to retest that low in the afternoon by 12:30, for example, which is a very important key time between 11 to 12:30 p.m., if price is coming down to retest those New York open lows after it has already swept the highs and pulled back in range, then you can take that counter trade buy as well, because usually that's when price is continuing the trend back to the upside after already sweeping the liquidity. That's one. Coming back to retest the low. That's two. And then the third opportunity is taking the counter trade buy as price now has retested the low area twice, where you can place your stop loss right below the previous session low or the previous market low where the structure is, and up and away it goes. All right. So these are some of the ways you can take advantage of a systematic behavioral price action like this, because if not, it's going to get the best of you. It's going to get to the best of you because price action is happening fast. Of course, we're speaking in hindsight, but at least it better prepares you for the next time that you see something like this happening and is giving you stress and you're not really sure what the heck is going on. At least now you have a way better outlook on what to expect, how to trade it, how to counter trade it, or how to wait and find the best timeline for you to take the trade. All in all, hopefully this brings a lot more clarity to you as far as which trade option works best out of those scenarios. Typically for me, I would wait for price to just come back to retest the low after it swept the highs. And at least it makes me feel a lot more comfortable to see the direction and the confirmation of where price wanted to go, so I can make a pretty good risk to reward decision out of the trade without having to second guess or overtrade. All right. So hopefully these conditions do ameliorate, because we're not really looking to do too much guesswork when it comes to trading. So that way it eliminates forced trades and multiple attempts, which is what gets us in trouble on the charts. But with that being said, hopefully this brought some clarity to you. I'll see you next time. Peace, love, and blessings.